Okay, so hello, my dear future chartered accountants. This is Chinmaya Hegde. I hope my voice is audible and PPT visible. Can you please confirm it once before we go further? Is the voice clear? Is the PPT visible? Okay, yes. Okay, so today our target is to cover two accounting standards. In fact, they are separate chapter. One is AS13, that is accounting for investments, and then AS3, that is cash flow statement. So first we will cover AS13, that is accounting for investments. So AS13 investments talk about broadly two types of investments. One is called as long-term investments and other is called as the short-term investment. Long-term investment means this is for once again. Long-term investment means this is for period held more than 12 months, and short-term investment means for a period held than less than 12 months. And coming to the accounting piece, long-term investments are valued at cost unless there is permanent diminution in the value of assets. You should make a provision for diminution only if it is permanent in nature. Only permanent diminution, only if permanent diminution. So you are investing in the shares of a company for 3 years. Now because of coronavirus, share price has gone down. You need not show the loss. But if it is so severe that company is almost closed, then you have to show the loss. So temporary fluctuations need not be shown, but permanent diminution should be shown. Short-term investments are valued at cost or market value, whichever is lower. Because for short-term purpose, any fluctuations should be made affect. But if it is the market value is higher, that is not being valued at. And then we have other elements. Okay, now what does cost will comprise of? Cost will comprise of purchase price and other charges also. Other charges such as brokerage charges, legal charges, stamp duty charges, those things are also part of the cost of the asset. Other elements like reclassification. You will reclassify from long term to short term, then whatever is your existing carrying amount becomes the new carrying amount. So lower of whatever existing carrying amount will be lower of the cost of the asset or the carrying amount. If the provision was made, the carrying amount would have been less. That would be the case. Then current to long term, if you move from short term, they don't use the word short term, actually they use the word current. So if you move from short term to long term, then whatever the lower of cost and market value, that is because you would have valued it on the date of reclassification, whatever is the market value, because during there you might reclassify. So lower of cost and market value. Sometimes it might also be by way of exchange of another asset. In that case, it will be fair value if the asset given up or asset acquired, whichever is clearly evident. And disclosures aspects are there, like method of valuation, because you might follow FIFO method of valuation, weighted average method of valuation, and so on. This is the broad view of it. So very simple standard, not much of complicated one. We have to understand, to be specific with respect to how to value equity shares investments, how to value debentures investments, especially concept of X interest, cum interest is involved. And those things will directly go for a problem and try to understand about it. I hope you are clear till here. Shall we go to the problems on accounting for investments involving fixed income securities and equity shares? Any questions so far? Shall we move further? Okay. Yes. To come to this problem, the following information is presented by Mr. Z relating to his holding in 9% central governments. Opening balance face value 1,20,000, cost 1,18,000, face value of each unit rupees 100, purchased 200 units, X interest 98, sold 500 units, X interest out of original holdings 100, purchased 150 units at 98 cum interest, sold 300 units at X interest at rupees 99 out of original holdings. Interest dates on 30th September and 31st of March. Mr. Z closes our books every 31st December. Show the investment account as it would appear in the books. Mr. Z follows the FIFO method. Okay, few terminologies. What is this X interest? You still have interest in your X? No. Cum interest means what? Simple words, X interest means excluding interest. X interest is excluding interest. And cum interest means cumulative. That means including interest. Cumulative of interest. Including interest. Okay. Now, how to calculate that part? Take a look at this example. Suppose company pays interest on 31st of March every year. Let's say you're in 31st of March 2020. Every year, next year will be 31st of March 2021. Every one year they pay the interest. Let's say Mr. X transferred to Mr. Y debentures or any fixed income security on 29th March 2021, 2 days before payment of interest. 2 days before payment of interest. So as on the 31st of March 2021, who is a debenture holder? Mr. Y. To whom the company will pay? To Mr. Y. How much does he get? He gets full amount. Sir, isn't that unfair? He is just a debenture holder only for 2 days. Why will he receive entire year interest? He does receive. Company cannot sit and do investigation. Who are the debenture holders? When did they transfer? How much interest they are accounting for it? They are not going to do that. On the date of payment, whoever is in their register, they will get the full year interest. Amazing concept, sir. Why? One day before you purchase, you get full 1 year interest. Amazing, very nice. But person who is selling is not a bakra. When he is selling, he will make sure he will sell including the element of interest. So when he is selling, for example, he is holding the debenture for a period of, let's say, 364 or 363 days, and he will include the interest and then sell it. That is, when this Y is paying the amount, he pays the amount not only for the cost, he also pays for the interest. And you collect the money from the company for 366 days. So 3 days will be your holding. Got the point? So on the date of purchase, on purchase, you make the payment to bank. You make the payment to bank. For what purpose you make the payment? You make the payment towards two things. That is what? You make the payment towards cost of the asset. That is what is investment account. Investment account. Towards cost of the asset. This is what is called as X interest. And you also pay towards interest. And this bank means it includes, this is X interest plus interest. Therefore, this is come interest. And reversal entry when you sell the asset. And what is this interest? This is interest accrued till the date of purchase. Till date. From what date? Of course, from the previous date of interest payment. So every time you buy or you sell, you have to compute interest accrued till date from the date of the interest payment till the date on which the transaction takes place. On purchase also you should calculate, on sale also you calculate. Amount attributable purely towards cost is called as X interest, and this interest amount plus X interest is what you are going to make the payment. I hope you are conceptually clear till here. Now we will prepare the solution for this one in the columnar format. So one column will have for face value or number of units, you can say. One column I'll have for interest column because I pay some interest, I receive some interest, net will go to P&L for that purpose, and cost, nothing but X interest column. Similarly, credit side also face value or face value, interest and cost. So this cost represents X interest. Cost represents X interest. Please have the format, then we'll fill up the numbers. Please have the formats. Okay, fine. So what we should do now? Let us list down the date of transactions one by one. So opening balance, you have 1,20,000, cost 1,18,000. Let's write down two balance brought down. 1,20,000 is face value, cost 1,18,000, interest is 0. Why this interest is 0, opening balance is 0? Because the previous date of interest payment is 31st of December and we are doing 1st of January. Year end is 31st of December and interest paid on 31st December every year, right? Interest is paid on 31st of, no, interest is paid on 30th of September, 31st of March. Oh, interest outstanding is also there because previous date of payment would be 30th September. Now we are on 31st of December. So opening balance interest accrued is there because 3 months interest accrued but not received. So you will have receivable account like debtors, receivable amount, to balance brought down. That amount we have to calculate. Okay, so we'll calculate opening balance from 30th of September 2007 till 1st of Jan 2008. Opening balance 3 months period, amount 1,20,000 for 3 months at 9%. This is opening balance. This is opening balance yet to be received. So this amount we can write 2,700 opening balance. Opening interest accrued. Opening interest accrued. Okay, next. Okay, what is the next date of transaction? On 1st of March 2008, you have purchased. How much cost you have purchased? 200 units at cost of 98. Ex interest you purchased. Still interest is accrued. So 200 into 98. 200 into 100 rupees the face value into 98 will go to the cost column, ex interest column. To bank 20,000 into 98, 19,600. And as on this date, you will have interest accrued. From what date? From the previous date of interest payment till the date of transaction. We are on 1st of March. Previous date of interest payment would be on what date? Previous date of interest would be on, they are paying on September, 30th of September. So 30th of September till 1st of March, 5 months. On 20,000 face value, 5 months interest, 9%, 750. So that we can write it down as 750. Okay, next. On 31st of March, because 1st of Jan over, 1st of March over, before we go into April, May, June transactions, 31st of March, you received the interest from the government. This from government bonds, you would have received the interest. To what extent you would have received interest? You would have received the interest on face value held as on this date. 1,40,000 is the face value. And on the 1,40,000, 6 months interest at 9%, that you received 6,300. 6,300. So you can write by bank in the interest column 6,300 interest received. Interest received. Okay, I'll do one small verification calculation, not required for exam, only for conceptual understanding. So what is the effective interest income as on this date? Effective interest income as on this date, 6,300 minus 2,700 minus 750. Can you please tell me how much it is? 6,300 minus 2,700 minus 750. How much is the effective interest income? Can you please tell me? How much you get? You get 2850. Okay, this is what is goes to P&L account. This is what you received effectively. Let's see, are you eligible for this number? Let's see the accrual part of it. What is the interest accrued? Interest earned? Interest accrued? You see, you are having 1,20,000 from 1st of Jan till 31st of March. So on 1,20,000 from 1st of March till 31st of March, 3 months at 9%. Can you tell me how much you get? 1,20,000 into 3 by 12 into 9%. Jan to March you are holder. So 3 months interest you have accrued, you have earned by holding the assets. $2,700, right? This is from opening balance. Now, additionally, you purchased 20,000. You purchased on 1st of March. So, how many months you are eligible for? You received for 6 months. That you forget. But you are a holder for how many months? Only for 1 month. So, you accrued interest. You are earning interest only for 1 month. So, on 20,000 face value for 1 month into 9%. Tell me how much you get? 20,000 into 1 month holding into 9%. What is the amount you get? 150, correct? Now do the total, you get 2850. You have received 2850 and you have earned 2850. See, perfectly matching. Even though you purchased on March 1 month before date of payment, you would have made already the payment of 5 months. You collected the 6 months. Effectively, you received 1 month interest. So whether you pay, you receive, don't worry. When you receive the money, it will be perfectly matching what you're supposed to receive to the extent of interest earned. Hope you understood all conceptually. Let's go further on faster manner for remaining part of the problem. Okay. Now, next transaction on 1st of July 2008, you sold. You sold 1st of July, sold 500 units at 100 X interest. So your selling price 500 into 100, 50,000 X interest. Interest also will have to compute. On buy also you have to compute interest. On sale also you have to compute interest. Okay. So buy bank, the X interest portion 50,000, 500 into 100 and interest accrued till date. This also 50,000, face value also 50,000, sale value also 50,000. Interest accrued from the previous date of interest payment from 31st of March till date of transaction 1st of July means for a period of 3 months. So 50,000 into 3 months into 9%, you hold the asset. You have accrued interest for 3 months which you collect from the person to whom you are selling. But one more point to be kept in mind is whenever you sell the asset, you have to calculate profit or loss on sale of the asset. That is always a hidden adjustment. Profit or loss on sale of investment. That is either on FIFO method or on weighted average cost method. In this problem, we are following FIFO method. So this 50,000 would be this cost 50,000 would be out of this original cost. So how much would be the sale value? 50,000. Sale value 50,000 means X interest. Remember X interest. This 50,000 cost portion minus cost. How much cost? FIFO method. This 1,18,000 is for 1,20,000 face value. But we want to know how much for 50,000 face value. So 1,18,000 by 1,20,000 into 50,000. 49,167. So you get gain on sale 833. And where will you transfer the gain? In the investment account. Remember, it's keep it like a trading account. Treat the investment account like a trading account. In the trading account, you write buy sales and 2 purchases. Buy closing stock, 2 opening stock. Remember the format of trading account? Yes. Now, where do you write gross profit in trading account? You write 2 gross profit or buy gross profit? You write 2 gross profit. Here also you write in the investment account 2 gain on sale which will be transferred to P&L account in the cost column 833. Please write down. Okay, next. Okay, hope you're done. Now this sale transaction is done. Let's go for next date. Next date of transaction is you again sold on 30th of September. No, you received the interest income. On 30th of September, you received the interest income. On how many face value? 1 lakh 20 plus 20 you had. You sold 50. Balance how much? 1 lakh 20 plus 20, 1 lakh 40 minus 50. 1 lakh, no, balance 90,000. On 90,000. 1 lakh 40 minus 50,000 face value sold on 90,000 for 6 months at 9%, you receive 4050. You receive 4050. Okay, next. Next transaction, 1st of March over, 1st of July over, 1st of October now. 1st of October you purchased. 30th of September you have received interest. 1st of October you are purchasing only one day. So no interest accrued for this. So directly it will go to the only cost column. No interest will be accrued on this one. Zero. You can still write for your reference. So on 1st of October, 15,000, cost 14,700 and interest accrued zero because only one day, no. So there will not be any interest accrued. You can ignore it. Zero interest. Zero interest. Then you sold on 1st of November, face value 30,000 at X interest of 99. So 99 into 300, 99 into 300, 29,700. And interest accrued from what date? From the previous date of interest payment, which is 30th of September. 30th of September to 1st of November. For how many months then? For a period of 1 month. Only 1 month, no, October month. So 225. And whenever there is a sale, you should also account for profit or loss. Let's compute the profit or loss. The sale value was 29,700. How much is cost out of original holdings? First in, first out method. 1,18,000 by 1,20,000, same proportion. But face value sold is 30,000. For 1,20,000, the cost is 1,80,000. For 30,000, how much is the cost? Balancing figure proportionate, you get 29,700. So profit on sale comes to 200 rupees. 200 rupees. So 200 rupees we will transfer it. On weighted average method, we will do in the next problem. When I do shares, the shares I'll do on weighted average method. Okay, next. Okay, so we have done with the profit on sale. Next, year end 31st December, accounts are closed. You are having a face value balancing figure. This is balancing figure, face value 75,000, and interest accrued from previous date of interest payment, which is 30th of September till December, for a period of 3 months. So on 75,000, interest for a period of 3 months, 3 by 12, 9%, interest accrued, closing balance 1688. You can find the balancing figure in the face value, and in the balancing figure in the interest column, balancing figure in the cost. Balancing figure cost will go to balance sheet. This will go to balance sheet, and this 1688, this also will go to balance sheet 1688 as an asset, and this 9938 will go to P&L. 1688 is this interest accrued, and 9938 will be transferred to P&L account. Please note down and see if you have any doubts. Okay, shall we go further? Okay, I'll move further. Hope this is fine. So come to next problem. On 1/4/2012, Sundar had 25,000 equity shares of X Limited at a book value of 15 per share, face value of 10 each. On 20th of June 2012, he purchased another 5,000 shares of the company at rupees 15 per share, 16 per share. The directors of X Limited announced a bonus and right issue. No dividend was payable on these issues. Terms of the issues was as follows: bonus issue 1:6, right issue 3:7, date 31st December, price 15 per share, due date for payment 30th of September. Shareholders can transfer their rights in full or in part. Accordingly, Sundar sold 33.33% of his entitlement to Sekar for a consideration of 2 per share. Dividends for the year ended 31st March 2012 at 10% were declared by X Limited and received by Sundar on 31st of October. Dividends for shares acquired by him on 20th of June are to be adjusted against the cost of purchase. Basically pre-acquisition dividend. On 15th of November 2012, Sundar sold 25,000 shares at a premium of 5 per share. You're required to prepare in the books of Sundar investment account, P&L account. For your exercise, assume the books are closed on 31st of December and shares are valued on average cost. So here we are following on weighted average cost basis. Okay, so have the format investment account. Here we will have number of shares and we don't have to have a column for any interest column. To have one column for number of shares and one column for cost. Date, number of shares, one column for cost. Please have the format, then fill up the numbers. Okay, now let's write the amounts now one by one. 1st of April, two balance brought down 25,000. No interest accrued here. No dividend will accrue here. 25,000. Cost is 3,75,000. Here 25,000 shares at 15 rupees each. 25,000 at 15 rupees each. 25,000 at 15 rupees. 3,75,000. Okay. Next, you purchased additional shares to buy 5,000 shares at 16 rupees. 80,000. 5,000 shares you purchased into 16 rupees. 80,000. 5,000 into 16 rupees. 80,000 you purchased. You received bonus shares, but bonus shares will not have any amount in the cost column, but number of shares you would have received. So they have received the bonus shares in the ratio of 1:6, 1 for every 6 shares held, 1:6. So you are having 30,000 shares into 1/6, which is 5,000. But nothing in cost. No cost. Cost of bonus share will not be there. Free shares. On right issue. Okay, right issue will write down. But please make sure you have done till here. Okay. Now, right issue. What is happening? Right issue 3:7. How many ever shares are there? Into 3/7. And Sundar sold 33.33% of his entitlement to Sekar for a consideration of 2 per share. So this so 33.33% he sold, right sold, not share sold. The right to receive, that is being sold. And then he acquired the balance shares, I think. He transferred the shares, but according to the dividends were received, dividends were shared, adjusting in cost of purchase. Okay. So he sold 33% means balance entitlement. We assume that he has exercised by making the payment on 30th of September. So how many right shares he is going to receive? 25,000 plus 5,000 plus 5,000. 3 for every shares held into 3/7, 15,000. This was a right issue. But he sold 33.33%. 15,000 into 33.33% sold, and remaining he purchased. Now sold, don't write in the sale 5,000 because you did not purchase only. So what you sold is only the right, not the shares. So don't write that 5,000 in the sale column. So whatever you purchased, you write 10,000 into 115 rupees. That you write 10,000 into 15, 1,50,000 you purchase the shares. But what you sold, right sold, sale of right, don't write as number column. I'm adjusting against the cost. Alternatively, this can also be transferred to P&L account. That treatment is also there. Alternatively, the sale of right value can be transferred to P&L. Both treatment exist. Both treatment exist. Please write down till there. Okay. Next, on 31st of October, you sold the shares. You received the dividend. How many shares you received the dividend? Okay. How many shares you have? Let's read that point. On 31st of October, dividend for share acquired by him on 20th of June 2012 are to be adjusted against cost of purchase. So this is for the previous year. So how many shares were there for the previous year? Please observe carefully this one. You received the dividend for how many ever share you received. But this 5,000 shares, what you acquired here on 20th of June, when you made the payment of cost, the seller would have included the dividend amount and he would have sold it to you. Therefore, on this 5,000 shares, which you acquired in the current year, which was acquired by somebody else in the previous year, includes an element of profit, includes an element of dividend. So we need to eliminate it. Pre-acquisition dividend on this 5,000 shares. On this 5,000 shares acquired. So 5,000 into 10 into 20%, 10,000. That will be adjusted against cost of the asset. Pre-acquisition dividend. Okay. Now, then again you sold. Uh, Sundar sold 25,000 equity shares. Okay, you sold 25,000 equity shares at a premium 15%. When there is a sale comes, profit on sale or loss on sale comes, where we follow average cost method. I'll show it to you how now. Okay, so by bank, you sold 3,75,000. Okay, now cost should be ascertained on average cost basis. What is the average cost basis? Cost 3,75,000 plus 80,000 plus 1,50,000 minus 10,000 sale of right. We have adjusted here. You can take it to P&L. In that case, it will not come here. 10,000 pre-acquisition dividend. What is pre-acquisition dividend? The dividend received for the period for which you are not a shareholder. Like you purchased on 20th of June. And this dividend relates to for the previous year where you are not the shareholder. Somebody else was the shareholder for the previous year. So when he sold the shares to you, he had included the element of dividend and sold it to you. So this cost includes an element of dividend. So when you paid for the share, the cost includes dividend. So when you receive dividend, it's not an income for you. It is a recovery of cost. Therefore, it should be adjusted with cost. In the sense, it should be subtracted from cost, which is what we have done now. And this is for how many shares you have? Totally 25 plus 5 plus 10, 45,000 shares. And you have sold how many shares? You have sold 25,000 shares. So proportionately for 25,000, 3 lakh 25. So profit on sale of shares 50,000, and that will be to profit on sale 50,000. And money, number of shares sold 25,000. Amount of consideration 3 lakh 75. To profit on sale. As I told you, treat like a trading account. Loss will come on credit side by loss, and profit will come on debit side to profit. On 31st December year end, you have remaining 20,000 units, and balancing figure you can say cost, or you can calculate like this. The same amount what you have is for 45,000 shares, and how much for 20,000 share closing stock. Or you can do balancing figure approach also. That way also you can tally. So this is the way you solve problem on shares, fixed income, variable income, fluctuating income securities, and on an average cost basis. Average cost is much more simpler. Total whatever the cost divided by number of units into units sold. That's all the answer. Okay, hope you got the point. So you can do cost as balancing figure, or you can also do by the calculation of working note what I've given. Both ways it works. Okay. Is it done? Shall we go further? Any doubts? Any questions? Okay. Hope we can go further. Okay. Now, financial statements of companies as per Schedule 3 of the Companies Act, more than accounts, it's more relevant for your auditing paper. Quickly, I'll go through it, but we will do problem on cash flow statement because balance sheet you know how to prepare, statement of profit and loss you know how to prepare. So cash flow statement is what requires a discussion. We will do problems. But quickly, going through the format of I'm getting one question related to the previous one. What would be the treatment if received equity share in conversion of debentures? You will have a debenture, now receive equity share. So you treat like a debenture sold and shares purchased. So debenture account would be credited and shares account would be debited. So investment in shares account debit to investment in debenture. So in the debenture account, you will treat it as a sale and profit or loss on sale is accounted. In shares, instead of writing to bank, you write it as to investment in debentures. Hope that is fine. Okay. Now coming to the balance sheet, liability side we have three varieties: shareholders funds, non-current liabilities, current assets, non-current assets. Now how do we decide whether current or non-current? If it is receivable, not past, futuristic, receivable less than 12 months, it is current. Receivable beyond 12 months, it is non-current. And normally we take 12 months, but not a compulsion that you should take 12 months. It's basically operating cycle. Operating cycle is nothing but whatever is your operating cycle you calculate in FM, working capital cycle, but without subtracting liabilities. Not net operating cycle, gross operating cycle. That is stock plus debtors, that is raw material holding days, WIP holding days, finished goods days plus debtor days. The net amount, don't subtract creditors. If it is let's say 75 days, then working capital, that 75 days becomes your definition of working capital operating cycle. So anything receivable within 70 days becomes your current, anything receivable beyond 70 days becomes non-current. So normally we say 12 months, but that is not a sacrosanct rule. Regarding the liability side, we have shareholders fund, share capital, reserve and surplus, money received against share warrants, share application pending allotment, non-current liabilities, long-term borrowings, deferred tax liabilities, long-term provisions, current liabilities, short-term borrowings, trade payables, other liabilities, short-term provisions. Format you should know. Asset side, non-current assets, we don't use the word fixed assets, we use the word PP. Intangible assets, non-current investment, deferred tax, long-term loan, current investments, inventories, trade receivable, cash and cash equivalent, short-term loans. Easy to remember asset side, ITC. I for inventory, trade for trade receivable, C for cash and cash equivalent. Easy to remember ITC. Statement of profit and loss, revenue from operations, other income, total income, minus expenses, cost of material, purchases, changes in inventories, work in progress, employee benefits, finance cost, depreciation, other expenses, profit before tax, profit for tax, profit after tax, then divide by number of shares, earning per share. If it is profit from discontinuing operations is shown separately. Anyway, this is a format of P&L account. I'm not going in depth. What is an important point to be considered is the cash flow statement. Cash flow statement that we discussed now. Cash flow statement we discussed now. Okay. Cash flow statement. It's a flow statement. So first of all, we will have the form of three types of activities are there. Or first we'll have like what is cash and cash equivalents. Cash and cash equivalents. Then activities. Cash flow taking place. Now cash and cash equivalent means anything convertible to cash within 90 days from the end of the financial year, within 90 days convertible into cash. So obviously cash balance will come, bank balance will come, even investment in bonds, commercial papers, even foreign currency, USD, and all will be part of cash and cash equivalents. Activities, we are having three types of activities. One is called as operating activities. Then we have financing activities. Then investing activities. What is operating activities? In the normal course of business. Operating activities are normal course of business. That is money paid to creditors, rent paid, money collected from customers, those kind of thing. Interest collected from customers, operating activities. Financing activities are related to share capital, shares issued, shares redeemed, and debentures, loans. These are financing activities. Investing activities are fixed assets purchased or sold, both cases, and even investment purchased and sold. So basically financing activities relates to liability side and investing activity relates to asset side. And in operating activities, we have two methods of preparation. One is called as direct method of cash flow statement. Another is called as indirect method of cash flow statement. Whereas for financing and for investing, we don't have the choice. We only follow direct methods. The indirect method is applicable only in case of operating activities. Investing, financing, only we follow direct methods. Okay. Before we go to problem, quick format discussions we'll do, especially with respect to the indirect methods. Okay, so cash flow statement, indirect method. Cash flow statement, especially indirect method. Okay, so what method we follow is this. First, we start from cash flow from operating activities. Cash flow from operating activities. Then we do cash flow from financing activities, or we'll say investing activities. Then cash flow from financing activities. After adding the three, we get D, that is operating plus investing plus financing, net cash flow during the year. Net cash flow during the year. Then we add opening cash and cash equivalent. We add opening cash and cash equivalents. The resultant what we should get is closing cash and cash equivalents. Now, among the three, investing is not so complicated, like sale of fixed assets, sale of investment, positive number, purchase of fixed assets, negative number, financing activities, shares issued, loan taken, loan share issued plus loan repaid, shares redeemed will be minus. Not a complicated problem. Only operating activities will be a small sort of issues. So in the operating activities, what we will do, we always starts from profit and loss account after tax. After tax, which usually if they don't give you P&L, we find out it as difference between the reserves and surplus of 2-year balance sheet, difference between reserves or 2-year balance sheet. But if you do like that, then you should do add a dividend paid also, dividend paid or dividend accrued in the current year, dividend proposed, because profit after tax means after adjusting dividends also, dividend paid if any during the year. So that also would be added back. Then tax provision also is added. Tax provision is added. Depreciation is added. Why tax provision is added? Because I'll subtract later. Whatever tax provision I'll add now, because I'm going to show it as a last line item minus tax paid. Depreciation I'm adding now because it's a non-cash item. To find out the profits, to find out the profit after tax, depreciation I would have subtracted. I don't want depreciation because depreciation is non-cash in nature. So add back whatever is done earlier, now reverse. Even profit on sale of fixed assets, loss on sale of fixed assets also is adjusted because sale is shown separately with the profit or loss separately. Similarly, we do adjustment. More importantly, we do adjustment for working capital. Adjustment for working capital. This is more interesting. Current assets, current liability. When current assets increases, that is like stock increase, you treat like a stock purchase. Why is that? You remember accounting equation, you know, when one asset increase, other liability should increase or another asset should decrease. Therefore, balance is maintained. So when stock is increasing, another liability should increase or another asset should decrease, then only asset balance will be maintained. Now we are trying to understand the impact on cash balance. The stock increase, cash is another asset. So what will be the impact on another asset? One asset increase, another asset should reduce. One asset increase, another asset will reduce. That's why cash current accounts increase means the impact on cash flow statement is minus. Current asset reduce means impact on cash flow statement is plus. Current liability increase, one liability increase, what is happening to other asset? Cash other asset, that is also a plus. So current liability increase is plus, current liability increase decrease is minus. Hope you're clear. Any doubts in these aspects? When we do problems, you'll get more clarity. Okay. Now, okay, I hope you are done with this. Okay. Now, among these three activities, can you tell me which is the complicated activity that you think you do lot of mistakes? Among the three activities, which is the activity which do you think you do lot of mistakes? Most probably, you'll do mistake in which category? Obviously, in operating activity, I'll give you one shortcut. Closing balance will be given in the problem. Opening balance will be given in the problem. Find out the difference. You get the net cash flow during the year. I assume you know financing activity. I assume you know investing activity. So work backwards and compute operating activities and show something as if you calculated this and got this number. Don't keep the amount as blank, because in that case, it will look like you copied from somebody. You should look like you got that number. So do profit as per P&L, choose, do some working capital adjustments, but your calculation should be working backwards. It looks like your cash flow tally. Obviously, the valuator will not have the time, patience, energy, interest to look after your all calculation, do it in calculator. He has better ways of wasting time. But remember, this works. This works assuming that your investing activities, financing activities are correct. There, if you screw it up, obviously this is not going to work. All the shortcuts are subject to conceptual risk. Please understand all the concepts carefully before applying shortcuts. If something goes wrong, I'm not responsible. Anyway, so to get more clarity, let us solve problems now. Hope you don't have any doubts. Okay, let us go to problem now. Let's do one full-fledged problem. So come to this problem. It might be there somewhere. Please search for it, this problem. The financial statement of a company are as follows. Cash on hand, short-term investments, sundry debtors, interest receivables, inventories, long-term investment, fixed assets cost, less accumulated depreciation, fixed assets, sundry creditors, interest payable, income tax payable, long-term debt, total liability, shareholders fund, share capital, reserves surplus. They have given P&L accounts also: sales, cost of sales, gross profit, depreciation, administrative interest expense, interest income, dividend income, foreign exchange loss, insurance proceeds from earthquake, disaster settlement, net profit after tax, income tax. Additional information: an amount of 250 lakhs was raised from issue of share capital. Further 250 was raised from long-term borrowings. Interest expense was 400, of which 170 was paid during the period. 100 relating to interest expense for the prior period was also said paid during the period. Dividends paid were 1,200. Tax deducted source on dividend received, including the tax expense of 300 for the year, amounted to 40. During the period, enterprise acquired fixed assets 350. Payment was made in cash. Plant with cost of 80 and accumulated depreciation of 60 was sold for 20. Foreign exchange loss of 40 represents reduction in the carrying amount of short-term investments in the foreign currency. Designed designated bonds arising out of change in exchange rate between the acquisition of investment and the balance sheet date. Sundry debtors and sundry creditors includes an amount relating to creditor sales and credit purchase only. Prepare cash flow statement under indirect method. Okay. So the trick is this: our focus should be on balance sheet. P&L account should only be a supporting document. Our focus should be on the balance sheet. So what do? We'll solve problem parallelly. We'll prepare the format of cash flow statement. We'll have the spaces for both all the activities, and then we go for any working note required. Then we come to the overall verification purpose. Okay. Okay. So cash flow statement under indirect method. Let's give the heading: cash flow statement. Indirect method. The first I will be having cash flow from operating activities. Cash flow from operating activities. I don't know whether space will be sufficient. Anyway, so I'll go to the next page and write it. Cash flow from investing activities. I don't think for investing I don't require too much space. 3-4 line is fine. Cash flow from financing activities. This also 3-4 line is fine. Cash flow from net cash flow during the year. After considering all the three, net cash flow during the year. Add opening cash and cash equivalents. The resultant what we get. Leave one line. I'll tell you why later. Then we write closing cash and cash equivalents. Any working note, we'll write it later. Working notes. Okay, very good. Let's do from the balance sheet. One googly is there. Be careful. They have given 2009 first, 2008 later. So don't tell it is increase. Right to left. Okay, one small googly is there. Many people realize after coming out of exam hall. Just be careful. Read from right to left. Don't read left to right. Current year first, then next year column. Okay. So what do we do is we'll read in this order. First, we'll take the liability side. Okay, now cash in hand and balance with banks, both of them will go to the balance sheet on the last line, working cash, that is cash equivalent. So opening cash and cash equivalent will be 25 plus 135. So let us go to the closing cash and cash equivalent. Please write in the same please write in the same speed. Otherwise, you will not be able to follow the process. You will miss the speed. Okay, make sure you are in the same speed as what I'm doing. Opening cash and cash equivalents is 25 plus 135. How much you get? 25 plus 135. Please tell me. 25 plus 135. And closing cash and cash equivalent 200 plus 670. The short term investment, I'm assuming it as cash equivalent. 200 plus 670. How much you get? 160 is opening cash and cash equivalents and closing 870. Closing 870. Okay, now one by one. So cash in hand is done. This is done. Debtors increase. So where we are going to write, let's write a quick format. Cash flow from operating activities. So I'll do profit as per Pnl account, net profit, or I can also say difference in reserves. Okay, then we are going to do some adjustment like plus depreciation, plus tax provision. Okay, plus then adjustment for working capital. Anything else might be there, some profit and loss and all might be there. So 2-3 lines more, then you write adjustment for working capital. Okay, now debtors increased. When debtors increases, cash balance reduces. So increase in debtors, remember increase. Okay, right to left, don't read left to right. 1200 becoming 1700. So increase in debtors 500 minus within brackets. Increase in debtors 500 within brackets. Interest receivable. Okay, 0 has become 100. Interest receivable. Can you tell me plus or minus? Interest receivable 0 has become 100 plus or minus. What do you think? 0 has become 100. So should I do minus or should I do plus? What do you think? Okay, it is neither minus nor plus because this interest is related to interest income where we follow direct method, we don't follow indirect method. So don't do plus or minus. When I say working capital, it should only be related to operating activities. Interest income, interest expense and all will not come here. Okay, so we'll have a separate ledger later. Working notes is there we write interest receivable. I'll prepare one ledger here. So buy balance carried down, closing balance I'm writing, amount is 100. Buy balance carried down, amount is 100. Not plus or minus. This interest income is a non-operating activity. So let's do one thing. Whatever related to interest income, we'll do it now itself. Go to P&L accounts. You see interest income 300, which is not an operating activity. Non-operating activity should be eliminated. So go to the this one and say minus how much amount? 300 minus interest income 300. So how much interest income you are going to write is interest receivable to P&L 300 current year income. So balance, did you receive 100 fully? No. Why? There is one more adjustments. What adjustments? Interest expense, interest, no, nothing actually. Deducted source, dividend received. Okay, on dividend received, nothing relating to this one. So how much received by bank? How much interest received? 170. 170. This 170 we will take it to the 100. Sorry, now why 170 I'm taking? 200. Sorry, 200, not 170. 200 balancing figure. So this is direct method. So 200 directly will go to investing activities, interest income. Interest income received. Interest income received 200. Are you able to write down this interest receivable account? To P&L 300. By bank. By balance carried down 100. And by balancing figure 200. That will go to P&L. So this bank will go to cash flow from investing activities. And this 300 is subtracted from cash flow from operating activities. Okay, hope you are clear with respect to this. Let's go back. So interest income, we have done the adjustments. Interest receivable is done. Okay, coming to inventories. Inventories and all normal thing. 1950 becoming 900. Reduction in inventories. So 1050. Working capital decrease in inventories. Plus decrease, so plus 1050. 1050. Next. Inventory is done. Long-term investment, no change. 2,500, 2,500. Fixed assets, accumulate depreciation, fixed assets. Let's prepare a ledger account, working notes. Fixed assets, gross. Fixed assets, accumulate depreciation. Don't say fixed asset, don't accumulate depreciation. Accumulated depreciation. So fixed assets here we write to balance brought down, opening balance, by balance carried down, closing balance. Whereas accumulated depreciation opposite, by balance brought down, trade balance, that's why, opening, to balance carried down, closing. From the amounts, let's write down from available amount from the balance sheets. So to balance brought down 1910, by balance carried down 2180, by balance brought down 1060, from the balance sheet to balance carried down 1450. 1450. Now what are the adjustments we are going to do? We take for depreciation from P&L account. Look at P&L account. How much is depreciation? Depreciation 450. Where do we transfer? We transfer to accumulate depreciation. By depreciation taken from P&L 450. Then on the assets sold, only that much will be transferred from accumulate depreciation to P&L account. What is the information they sold? Please read. Plant with original cost of 80, accumulate depreciation of 60 was sold for 20. So accumulate depreciation is 60, right? Only that will be transferred between the two ledgers. Only when the asset is sold, the accumulate depreciation transferred from the accumulate depreciation to the fixed assets account. Only in the year of sale. So here I'm going to write it as two fixed assets on sold, on sale 60. By accumulate depreciation 60. By bank sold, no? So by bank 20. So sale value 20. WDV cost is 80. Accumulate depreciation 60. So 20. No profit, no loss. Otherwise, I would have done either by profit, by loss, or to profit, just like trading account. Profit means to, loss means by. Okay, I think this depreciation account tallied. So no balancing figure, and here balancing figure is there. Tell me balancing figure, what do you get here? Balancing figure, to cash or to bank? Tell me the balancing figure in fixed assets account, what do you get? Balancing figure in fixed assets account. Calculator working. What's the balancing figure? An issue with the internet. I'm not getting any answers. Are people there? Can you please confirm? Hello? I think I should disconnect. I think it's a problem with the internet. Shall I close it and share a fresh link? Okay, I think I'm unnecessarily coming live and doing problems without response. I think going forward I'll do a record and I'll upload. That's better. That will save my time. My efforts also will get saved. Okay, so balancing figure here, I get 350. Balancing figure I get 350. So what are the treatment these things? Depreciation will be added in cash flow from operating activities. It will be added. Depreciation is added by bank. This is going to be considered in cash flow from investing activities. This 350 also will be considered in cash flow from investing activities. So let me do those adjustments. So depreciation, I've already taken the amount. Let us add back. Depreciation amount to be added back is 450. Then let me go to investing activities. In the investing activities, purchase of fixed assets, 350, and sale of fixed assets, sale of equipment, whatever it is, 20. Sale of equipments, 20. Okay, so going back to the balance sheet I was doing, so we have considered the depreciation element. Okay, assets is done. Coming to liabilities, 1890 has become 150. Decrease in creditors, decrease in creditors, that is minus 1740. Then Interest payable, again, it's not an operating activity, so ledger account you prepare. Income tax payable, you prepare ledger. Long-term debt will prepare ledger. So for all those three, I'll prepare separate ledgers. Interest payable, I'll prepare separate ledger. Opening balance, buy balance brought down 100. Closing balance, to balance carried down 230. And current year interest expense will go to P&L account. P&L account interest expense is 400. So buy P&L 400. The balancing figure to bank 270. This will be added in cash flow from operating activities. This will be subtracted in cash flow from financing activities. Cash flow from financing activities. Okay, so let's do those adjustments. Cash flow from financing activities, interest paid 270. In operating activities, I will add back interest expense 400. Interest payable is done. Income tax payable, let's prepare separate ledger again. Income tax payable, by balance brought down. Opening balance 100. To balance carried down. Closing balance, opening balance 1000. Closing balance 400. And current year from the P&L account 300 by P&L 300. Then they have not paid the balancing figure because some amount is adjusted by way of TDS. Look at the interest. Tax deducted source on dividend received, including the tax expense, is 40. So that 40 is not paid in cash. That 40 is paid in the form of TDS. So we write 2 TDS 40. 2 TDS 40. Balancing figure to bank. That comes to 860. So P&L accounts 300. This will be added initially in cash flow from operating activities. This will be paid or subtracted at the last. Subtracted at last in cash flow from operating activities. Okay, so let me go to those operating activities and do it. So tax provision, I already made the line. Tax provision 300. And in the last line I'll write, here only I'll write, I hopefully this space sufficient, less taxes paid. Last line, taxes paid 860. $300, 860. Okay, now Income tax payable is done. Let's go to long-term debt. That ledger also I'll prepare. Long-term debts. Long-term debts. Opening balance. By balance brought down. 1040. Two balance carried down. Closing balance 1110. Then they said in the information an amount of 250 was raised. Okay, 250 was raised from long-term borrowings. So by bank 250 and balancing figure is repaid to bank. Balancing figure is repaid to bank, which is 180. So both 250 and 180 will come in cash flow from financing activities. So long-term debt raised. And long-term debt repaid. Raised 250 and repaid 180. So repaid will be within brackets. So long-term debt, total liability is done. Shareholders funds will come to it. Share capital increase. They only said issue of share capital 250. Again, financing activity will take it. Issue of share capital. Share capital raised along with premium 250. So we have done with this point. Reserves 1380 becoming 3410. So how much will be the reserve? Increase in reserve 3410 and 1380. Increase means how much? You get 3410 minus 1380 2030. But is it the P&L account? It's not 2030, 3230. Why? Because they have paid dividend of 2200. So if I say profit as per P&L account, it is 3230. Profit as per P&L account 3230. But if I do as per increase in reserves, that comes to 2030. Then if I do follow that method, then I should add dividend paid 1200 dividend paid. Then it will come to same number 3230. Okay. So and dividend paid, I'll take it in financing activities. Dividend paid financing activity 1200. Dividend paid financing activity 1200. So we have done with the reserves adjustments also. Okay, let's come to the P&L account now. Sales is fine, cost of sales is fine. Eliminate non-operating items and non-cash items. 3230. Okay, fine. Non-operating items and non-cash items you eliminate. Depreciation we already added. The administrative is operating item. Interest expense we already considered. Interest income is already considered. Dividend income we have not considered yet. Dividend income 200, but dividend income 200 had TDS of 300, so you have not received the full amount. So dividend income, what will happen? Should be eliminated here. So minus, I'll subtract here, minus dividend income. Why I'm subtracting here? Because it is already added, now to be removed. Why should be removed? Because it is not an operating income. Dividend income is an investing income, non-operating income. So should be eliminated. So minus 300. 200. 200 should be eliminated, minus 200. And this I will take it to investing activities, say dividend received, but I don't receive full dividend. Dividend received. Why I have not full received? Because out of 200, 30 was adjusted as TDS, tax deducted source. Balance I received only 170. So 170 only will become your, no, not 170, 160. 160 becomes your dividend received in financing activities. So this also done. Foreign exchange loss. Okay, foreign exchange loss, they said it is representing reduction in the carrying amount of short-term investment. So this loss is unrealized gain, unrealized loss, because it is change in the investments. You're not sold, you're not purchased. So it should be added back, unrealized, added back. So in this account, you can say plus, you add back foreign exchange loss 40. And why I'm adding back? Because it is a loss which was subtracted earlier. Now I'm adding it. I'm reversing the previous effect. So adding here foreign exchange loss, I'm adding here, and I have to do a subtraction somewhere. Where I'm going to subtract? In the opening cash and cash equivalent is there. This I'm going to reconciliation less foreign exchange loss on cash and cash equivalent short-term investments. Why? Because opening balance it is there, but closing balance amount reduced. The difference amount should be shown by way of reconciliation. So whatever amount I've added back as loss, now I'm going to subtract. Gain, I would have done the reverse. Gain, I would have done the reverse. Okay. So we have done with respect to this. Insurance proceeds is an extraordinary activity, disclosed separately. It's an extraordinary activity. So we do one thing, this is V minus, then we do plus also. That's all the thing. So here what we do is, this insurance loss we subtract minus loss or profit, insurance claims, insurance proceeds. Insurance proceeds, I subtract 180, then I add separately plus insurance proceeds. So in fact no impact, but presentation should be there. Insurance proceeds because extraordinary activity to be shown separately, plus 180. Impact shown separately for, so that the validator will understand. 180. So subtract earlier, added later. Okay. So see what amount you get now. Operating activity, how much you get? You get 1870. I think you are getting it. 1870. Okay, so operating activities 1870. Coming to investing activities, 30. Financing activities, 1150, and net cash flow 750, and closing cash and cash balance should perfectly match 870. So that's how the amount tallied. And I was telling you about the shortcut earlier. I will tell you that method, how to get that number reverse process. So this anyway 870 you get. Closing balance, 870 will be there obviously. Then 870, this minus 40 if you do, even if you ignore is also fine, let's say. So 870 you do reverse working. Reverse working means plus 40 and minus 160. You should get 750. 870 plus 40 minus 160, you get 750. Then plus 1150 minus 30, you should get operating activities. Plus 1150 minus 30, you get same number by way of reverse working 1870. Okay, so this is about cash flow statement problem, indirect method, a full-fledged one, including shortcut I told you. I think all the adjustments have been taken care. Interest, TDS, interest acquired, plant, foreign exchange loss, the debtors, okay, everything is considered. Okay. So this is cash flow statement and financial statements of companies. This is for today's session. Tomorrow onwards, I think I will not come live because very poor response. Only few people watching. Maybe I'm not teaching well. That's also fine. I accept it. That's not a problem. So what I do from tomorrow onwards is I'll record it. I'll upload it because to come online, I also have to sacrifice few of things, which I believe it's not worth it from my side. So from tomorrow onwards, I will be uploading the videos. I'll record it. I'll upload the videos and you please watch at your convenience. Anyway, people asking doubts and doing coming online is not many. So no point in sacrificing from my side so much. I've got other priorities. Let me try to fulfill it up. So this is for today's session. From tomorrow onwards, no live session. I will be uploading the videos. Okay. So take care. See you. Bye-bye.